So let's get started talking about technical indicators. Now, traders who subscribe to technical analysis operate under the fundamental theory that price moves in patterns and that price never lies. To the inexperienced eye, a financial chart may look like an unpredictable line with jumbles of colors and marks. But these traders are watching charts to pick up on the subtlest of indicators of where prices could be headed next. So we're going to look at a breakdown of some of the most common technical indicators. Now, the main similarity between technical analysis indicators is that they are all based on price action. The open, the high, the low, and the close and volume are all used in their calculations. And this small number of variables can produce hundreds and even thousands of indicators. Now, most traders mix up technical analysis and technical indicators. Technical analysis is the entire study of price action on charts, because everything is tied to a chart. So if you're looking at just a chart and you're looking for a trend line, or you got a simple moving average on a chart, or you're just looking at a line chart and looking at prices, that's all technical analysis. Then if you're looking for triangles, head and shoulders patterns, you're looking at historical data, that's all technical analysis. Technical indicators are a specific part of technical analysis, but they're not the entire story of technical analysis. A technical indicator is a mathematical calculation that can be applied to an asset's past patterns like price, volume, and even other technical indicators. Technical indicators do not analyze any part of the fundamental business like earnings, revenue, profit margins, news, headlines, interest rates. Technical indicators are most extensively used by active traders in the market, as they are primarily designed for analyzing short-term price movement. To long-term investors, most technical indicators have little to no value. Now, technical indicators fall mainly into two categories. They're called leading and lagging. Now, do not think that these names are derogatory. A lagging indicator is not a bad thing. A leading indicator is not a better thing. Leading indicators are those who lead the price movement. They give us signals before the new trend or reversal occurs. Lagging indicators are those who follow price action, and they give us a signal after the trend or the reversal has occurred. So to explain this a little bit easier, imagine you shoot a rocket off into the sky. It's going to go up, 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 and up. At some point, it's going to lose its momentum. And as it loses its momentum, at some point, it's going to flip over and come back down to Earth. Now, a leading indicator will tell you that the momentum is waning. It won't tell you when it's going to flip over and come back down to Earth, but it'll tell you that movement up is slowing down, or is, in some cases, we could call it overbought or oversold, but is coming to an end. Where a lagging indicator doesn't come into effect until it's lost its momentum and turned downward. And it then tells you that it is definitely a new signal or a reversal has started. So that's the only difference. It's where they come into play as opposed to being good or bad. Now, indicators from both categories fall into the following types. And there are several types of different indicators, and understanding which indicators fall into what category is very, very important, because we combine indicators to help us understand the markets, to help us get entry and exit points or transaction signals, to help us know whether the trend is about to reverse, and to determine how volatile the market is. Now, we wouldn't want to put together in our trading system 4 indicators that all were giving us volatility, and we're ignoring trend indicators or momentum indicators. So we need to know which categories they fill in and what purpose they serve. So we have trend indicators, momentum indicators, volatility indicators, and volume indicators. So the first category, and one of the most used categories, falls under the group called trends. They identify trends over different time frame, or identifying trends over a different time frame are useful because it can help weed out the noise of daily volatility. Any type of trend, including uptrends, downtrends, and sideways trends, can be traded for profit so long as it's shown to be consistent. Now, trend traders use a number of different indicators to help them figure out what kind of trend an asset is in. One of the most popular is simple moving averages, which represents a single line that represents the stock's or the asset's average price over a given period of time. And then there's other ones that we know well, MACD, moving average convergence and divergence, or ADX, average directional index. These are all indicators of whether a trend will continue or is coming to an end. Now, volume indicators, which is very, very important because volume helps confirm the price movement. Any trend or any movement with higher volume is more dependable, more reliable. When an asset makes a move and there's not volume, tells you it's not supported by the traders. So volume, of course, is the measure of the total number of shares or contracts that are traded in a given period of time. When volume really comes in handy is for confirmation. Many traders use volume to confirm the conclusions from other types of indicators, such as trend indicators. Sometimes market conditions and the lack of liquidity alone can temporarily drive an asset's price higher or lower. However, these moves are often occur on relatively low volume and can be short-lived. So let's go over real quick to a chart, and I've got several charts set up for us tonight. And number one, all technical indicators are either overlays that overlay the price action, or they are put on underneath the chart. Now, in this chart, we just simply have a bar chart for gold. On the bottom, we have our volume indicator, which is telling us a volume of trades. And we can see as that volume moves up and down as long with price. So we see gold recovering today after a substantial sell-off because the dollar has gotten very, very strong. And we see gold moving up. Now, as we saw gold pushing upward, we saw a jump in the buying pressure. Gold hit 1268, and it seems like the buyers have eased out of the market, but it's also the end of the trading day. But now let's take a look at indicators. So let's take one of the most well-known ones, which is called Bollinger Bands, which we're going to talk about tonight. That's one of the few indicators that's actually placed over top of price. Okay. So that's an indicator, and it's laid on the chart over top of price. Then we have indicators like RSI and stochastics. Let's pull one up here. Relative strength index that are placed on the bottom of the chart. Now, there's certain indicators that we call bounded indicators or bounded oscillators. And they fall into all these categories, but as you can see with RSI down below, its calculation and its formula always come out between 0 and 100. So it's bounded. It's bounded in that number. And we know, or the indicator set up, that between 30 and 70, it means very little. We're looking for it to go above 70 or fall below 30. Okay. And that's one type of an indicator that's placed on our chart. Okay. We also have indicators like MACD that are placed below on our chart that have crossovers. And when those crossovers when those lines cross each other, they trigger transaction signals, buy or sell signals. So we have all different types of indicators we want to use that incorporate into our strategy, but we have to still understand where these indicators fit into the scope. Are they telling us the momentum of an asset? Are they telling us the volatility of an asset? Are they telling us that a trend is currently over or is starting or confirming a trend. But we have all different types of indicators that we can combine into trading strategies, and then how to use those indicators. But you'd have to learn to use each one of those indicators. But before you pick and choose what you want to use, you have to understand what categories they have and why you might want to use them. Because there's literally thousands of different indicators on the market. Now, the oldest ones that have been around for a very, very long time, like RSI, MACD, stochastics, are well proven and have stayed this long as being popular indicators because they're very reliable. So let's go back and start figuring out what category some of these indicators fall into. So let me pull up our PowerPoint again. So we talked about trend indicators. We've just talked about volume. Now, a very important group of category of indicators, and one I depend on a great deal, is called momentum. Because I'm always concerned with the momentum an asset has to trade it. Because a momentum indicator is like a speedometer. They show how fast an asset is moving in a given direction. These indicators are typically displayed as oscillators, which fluctuate above and below a baseline to indicate how much positive or negative momentum an asset is experiencing. Now, arguably, the most popular of the momentum indicators is that of RSI, or Relative Strength Index. Now, that's what I was showing you on a chart a minute ago. RSI is represented by a chart that tracks a stock's price on a scale of 0 to 100. When RSI charts have lines at the 70 and the 30 mark. If an asset moves above 70, it's considered overbought, meaning there's too much buying pressure on the stock and it could fall lower. Momentum, we talked about the rocket. Well, when the rocket's shot up high in the air, but we don't have the calculation when it's going to fall down. We don't know about gravity and all those calculations. We want something that tells us that momentum is waning, letting you know that it's still rising, but doesn't have the momentum it had when it was first shot off. So if the stock moves below 30, it's a signal that that asset is oversold and the buyers could soon come in and drive the prices higher. So this includes RSI, stochastics, commodities channel index, CCI, and Williams percent R. Then we go into a very important class of indicators, and these are called volatility. Volatility is a measure of how large an asset's movement is in a given period tends to be. When an asset makes large moves in a short period of time, it is considered volatile. Volatility is a very important indicator for traders because volatility makes it easier to profit due to price inefficiencies. Without volatility trading, opportunities would be limited. So we want to trade in markets that are, number one, trending, that have momentum and have volatility. But we also need to be able to gauge that volatility to determine where to put our stop losses, how far up or down that asset should bounce in a period of time. Now, volatility is so important to traders that the Chicago Board of Options Exchange Volatility Index, or the VIX, is one of the most followed indicators in the world. It's referred to as the fear index. Now, it's predominantly for the stock markets, but there's now actually a VIX for just cryptocurrency. So in addition to VIX, traders use volatility metrics such as average, true range, Bollinger Bands, and envelopes as trading indicators. Now, in each of these categories, we have several different types of indicators. In fact, we have lots of indicators. But the most popular when we're talking about trend indicators are simple moving averages. Moving averages are used to identify current trends and trend reversals. Now, a moving average is a lagging indicator. We have moving average convergence and divergence, MACD. It's used to reveal changes in strength, direction, momentum, and the duration of a trend in an asset's price. It's a lagging indicator also, but it serves many purposes. So one of the most reasons that MACD is one of the most popular indicators in the marketplace is because it is used in many different ways and can provide you basically all the information, whether the market's overbought or oversold. It'll show you divergences, it'll show you convergences, it'll show you entry and exit points. Now, as we go through these, you're going to find there's very few leading indicators. Remember, a leading indicator gives trade signals when the trend is about to start. They try to predict price by using a shorter period in their calculations, thereby leading the price movement. The most popular leading indicators are stochastics, MACD, and RSI. Lagging are those that follow price action. They give a signal after the trend or the reversal has started. Use them to determine a trend. The most common lagging indicator is a simple moving average. Now, these technical indicators measure the direction and strength of a trend by comparing prices to an established baseline. So, trendings are moving averages. They're used to identify trends and reversals, as well as to set up support and resistance levels. Moving averages can also be combined into multiple period moving averages for an entire trading strategy. So you can have faster and slower moving averages. Then we have, again, MACD. It's used to reveal the strength, change in direction, momentum, and duration of a trend. Now, these indicators are designed to show traders and investors the trend or direction of an asset they are trading. The trend of an asset can be either downward, upward, or sideways. Trend followers are an example of traders who use trend indicators to analyze the markets. Then we come to the group, as we talked about, momentum indicators. The most important of these, and all three of these are leading indicators, and they are also three of the most accepted indicators in the trading markets. We have stochastics, we have CCI, Commodities Channel Index, and we have Relative Strength Index, RSI. Now, these technical indicators may identify the speed of price movement by comparing the current closing price to previous closes. Stochastics is used to predict price turning points by comparing closing price to its price range, while Commodities Channel Index is an oscillator that helps identify price reversals, price extremes, and trend strength, where RSI measures recent trading strength, velocity of change in the trend, and magnitude of the move. So the momentum is a measure of the speed at which the value of an asset is moving in a given period. Momentum traders, now we just looked at trend traders. Momentum traders focus on an asset that are moving significantly in one direction on a high volume. For that, they use momentum indicators. So as you can see, momentum indicators are essentially composed of oscillating indicators that are usually used to determine overbought and oversold positions. Then we come to category 3, which we talked about earlier, volatility. Now, volatility is the measure of the rate of price movement regardless of direction. This is generally based on the change in the highest and the lowest historical price. They provide useful information about the range of buying and selling that takes place in a given market and helps traders determine points where the market may change. These are made up of Bollinger Bands, which is one of the most respected indicators. And this is the one that I dropped on the charts for you before that I showed as an overlay of price action. It's a lagging indicator. Then we have ATR. It's not as popular because it's a little bit more complicated. And then we have standard deviation. And standard deviation is a unique mathematical calculation that can help understand the momentum and the volatility of certain price movements. Okay. My favorite and my most important for me as a trader are, again, volume. Okay. These technical indicators measure the rate of the price movement regardless of direction. Bollinger Bands measures the highness and the lowness of price relative to previous trades. Standard deviation is used to measure expected risk to determine the significance of certain price movements. Volatility is so important in trading that you can find several indicators that measure it or use it to generate signals. The volatility is the relative rate at which the price of an asset moves up or down. A high volatility occurs when the price moves up and down quickly over a short period of time. And then lastly is volume, which I told you earlier is one of the most significant indicators, because by seeing the volume, how many trades or contracts are going on, will tell you what other traders are doing. Are they supporting that price movement or not? Because a price move, no matter what you see, if you think an asset's moving up or down, okay, without any support from volume, tells you it's not worth, because the other traders and the other investors aren't trading that. And you're not a lone wolf. You're not outsmarting them all. So volume indicators measure the strength of a trend or confirm a trading direction based on some form of averaging or smoothing of raw volume. The strongest trends are often occur while volume increases. In fact, it is the increase in trading volume that can lead to large movements in price. So these technical indicators measure the strength of a trend. We have Chaikin oscillator, we have on-balance indicator, and we have volume rate change. I just use the raw volume data that we saw at the bottom of our charts. The volume of trades is a very important component in trading. It is, for example, used to confirm or infirm a continuation or a change in an asset's direction. Many indicators are also based on volume. For example, the money flow index is an oscillator tied to volume that measures the buying and selling pressure using both price and volume. Now, it's important to understand with an indicator when they're talking about overbought and oversold. Okay, because it's like I explained to you with a rocket. When a security is overbought, the implication is that buying has pushed the price too far up, and a reaction called a price pullback is expected. When an asset is oversold, the implication is selling has pushed the price too far low, and a reaction called a price bounce is expected. Now, the fact is, an overbought market can remain overbought. So imagine that rocket moving up, and as it is losing its momentum, it could still continue upward. Okay. Now there's other calculations that if we had mathematical calculation, understood gravity and everything else, we could calculate exactly when it's going to tip over. But us as traders, we just know that it's still moving up, and we don't know how far up it's going to move before it flips over and starts returning to earth. Now, remember, indicators indicate. Too many traders want to bet their full apple cart on indicators. The fact is, indicators are nothing but a secondary system. Price action and price movement on charts, trend lines, support and resistance, and chart patterns should be your first line of defense. Now, remember, indicators indicate. This may sound straightforward, but sometimes traders ignore the price action of an asset and focus solely on an indicator. I have more people in my beginners classes who want to tell me, oh, I want to trade from stochastics. I want to trade, or I use RSI and stochastic. When they do this and this, I trade. They'll eventually lose their shirts. Indicators filter price action with formulas. As such, they are derivatives and not directly reflections of price action. This should be taken into consideration when applying analysis. In other words, MACD might give you a beautiful crossover. The MACD line might cross that signal line right up, and everything could be perfect. Tell you buy now. But if you're not looking at the trend line and you're not looking at the price action, it could be completely wrong. You should look at price action, trend line, support, and resistance, and then look for a little bit of confirmation from an indicator, not the other way around. So as such, they are derivatives and not direct reflections of price action. This should be taken into consideration when applying analysis. Any analysis of an indicator should be taken with the price action in mind. What is the indicator saying about price action of a security? Is the price action getting stronger or weaker? Even though it may be obvious when indicators generate buy and sell signals, these signals should be taken into context with other technical analysis tools. An indicator may flash a buy signal, but it's the chart pattern showing a descending triangle with a series of declining peaks. It could be a completely false signal. As always in technical analysis, learning how to read indicators is more of an art than it is a science. The same indicator may exhibit different behavioral patterns when applied to different assets. Indicators that work well for gold or for stocks might not work well at all for cryptocurrency. Some indicators work very well in very short-term markets, 15-minute, 30-minute charts, but and others are complete failures in short term because they don't react fast enough. So through careful study and analysis, expertise with the various indicators will develop over time. As this expertise develops, certain nuances as well as favorite setups will become clear. Now, the fact is, there are hundreds of indicators in use today, with new indicators being created, listen to that word, created every week. Technical analysis software programs come with dozens of indicators built in and even allow users to create their own. And this is one of what I see is the biggest problem we have with computerized charts, computerized trading, because it gives us all of this ability to have all of these indicators and oscillators at our fingertips without understanding exactly what they mean. And when you're not drawing them or calculating or putting them on the chart yourself, you just kind of get lost in some guru out there tells you when this indicator does that and it crosses over here, go buy. And you never understand the indicator. All you're doing is duplicating a rule somebody gave you. And also, all these computerized charts give us the ability to change the indicators, to adjust their input values. Well, this is fine if you understand the indicator inside and out. That's the first thing. The second thing, when each one of these indicators was developed, it's been back tested over years and years and years. It's been tested forward by thousands and thousands of traders. So we know the 9-day and the 26-day and the 12 period that they were developed work great. When you adjust it, which all these charts allow you to do, well, guess what? It's no longer stochastics or RSI or MACD. It's now Barry's indicator. Okay, Barry's indicator needs to be tested. Barry's indicator needs to have rules set up with it. And this is also what happens with these gurus out there preaching these strategies in the market. And they'll tell you to change Bollinger Bands to a 2.5 standard deviation. And they'll tell you some rules they give you, but they're not going to give you all this back testing. You're not going to be able to read. So what happens is you go out and read in the marketplace about Bollinger Bands, but they didn't tell you. You're really not using Bollinger Bands. You're using Bill's Guru adjustment of Bollinger Bands. So given the amount of hype that is associated with indicators, choosing an indicator to follow can be a daunting task. Even with the introduction of hundreds of new indicators, only a select few really offer a different perspective and are worthy of attention. And that's why when we went through those, I mentioned all the biggies. Those are the ones you really should be paying attention to. Now, strangely enough, the indicators that usually merit the most attention are those that have been around the longest time and have stood the test of time. When choosing an indicator for analysis, choose carefully and moderately. Figure out what category they fit into. Don't pick out indicators that duplicate each other. So attempts to cover more than 5 indicators are usually very futile. It is best to focus on just 2 or 3 at the most. You don't need to overcomplex your trading. There is no gold, golden fleece, out there that's going to tell you everything. Okay, there is no perfection. Price action is going to dictate everything. So limiting yourself to one or two indicators, or one indicator you know well and trust, and using that with support and resistance, trend lines, chart patterns, and price action gives you everything you need. So try to choose indicators that complement each other instead of those that move in unison and generate the same signals. For example, it would be redundant to use two indicators that are good for showing overbought and oversold levels, such as stochastics and RSI. But do you know how many charts I look at, how many traders send me their analysis to take a look at? And they're using both stochastics and RSI. Why? There's even now together a stochastics RSI indicator. So both of these indicators measure momentum and both have overbought and oversold levels. One of the reasons that MACD is so popular out there because it covers all the fields. It'll give you overbought and oversold. It'll give you entry and exit signals. It'll give you convergence. It'll give you divergence, and it gives you trend indicators. That means you can use one indicator and use different. You use it differently, but use one indicator, and it'll cover every bit of information you need. And remember the difference between leading and lagging. Leading influences future performance. Lagging analyzes past performance. As their name applies, leading indicators are designed to lead price movement. Most represent a form of price momentum over a fixed look-back period, which is the number of periods used to calculate the indicator. Okay. Now, understand when you're picking your indicators which category they fit into, because there's drawbacks of either. There are clearly many benefits to using leading indicators. Early signals for entry and exits are the main benefit. Leading indicators generate more signals and allow more opportunities to trade. Early signals can also act to forewarn against a potential strength or weakness. But because they generate more signals, leading indicators are best used in trending markets. These indicators can be used in trending markets, but usually when the major trend, with the major trend, not against it. Lagging indicators, as the name implies, lagging indicators follow price action and are commonly referred to as trend following indicators. Rarely, if ever, will these indicators lead the price of a security. Trend following indicators work best when market securities develop strong trends. Now, one of the main benefits of trend following indicators is the ability to catch a move and remain in that move. So remember, all have their benefits and their drawbacks. So for technical indicators, there is a trade-off between sensitivity and consistency. In the ideal world, we want an indicator that is sensitive to price movement, gives early signals, and has few false signals. If we increase the sensitivity by reducing the number of periods, an indicator will provide early signals, but these number of signals will increase. If we decrease sensitivity by increasing the number of periods, then the number of false signals will decrease, but the signals will lag, and this will skew the reward to risk ratio. Now, oscillators are most effective when used in conjunction with pattern analysis, support and resistance identification, trend identification, and other technical analysis tools. By being aware of the broader picture, oscillator signals can be put into context. It is important to identify the current trend or even to ascertain if a security is trending at all. oscillator readings and signals can have different meanings in differing circumstances. By using other analysis techniques in conjunction with oscillators readings, the chances of success will be greatly enhanced. So on that note, I'm going to say goodnight to everybody. I hope you learned a little bit about technical indicators. And then we have all kinds of classes that come up on each individual indicator, and we'll teach you how to use MACD. We have a whole class on MACD, a whole class on RSI, a whole class on stochastic, whole classes on moving averages, because you have to learn to properly use each one of these or whichever ones you're selecting. And my best advice to you is to start off with simple moving averages and a MACD, or just start off with MACD. Master it, or pick one of interest to you and just master it. Get to know all the little nuances, the ins and outs, understand the calculations, how it reacts to the market, and watch it over and over and over so you can identify solid signals and false signals. Okay. And learn to use one indicator before adding more onto your trading strategy. And don't combine them together because some guru told you, do this, and do this. And when this number comes out and that number comes out, make that trade. Learn how to use them yourself and interpret them on your own. Have a good night now. Thank you for supporting CMS Trader and investing.com. And remember, if you go to www.cmstrader.com and open a demo account and also click under their education tab, you can watch whole classes, download ebooks on all of these indicators. Have a good night now, and thank you for joining us.